Hey, what's going on, you guys? It's your boy Joe, man. You already know what time it is. You already know what time it is, guys. We are back with another video, guys. I just want to say really quickly, thank you guys so much for 170 subscribers, guys. I can't even thank you guys enough for that. We're killing it, man. So today I have a little bit of a different video for you guys. And, I know I post a lot of gaming videos and stuff like that, but my channel is overall whatever I want to post. It's my channel, and, I like to share a lot of valuable content with you guys. And, it doesn't really matter if I don't do gaming videos. I just like to post what I love to do, and I want you guys to join me with that. Now, today we're going to be looking at stocks, guys. Now, I know there's a million videos on stocks. Like, it's ridiculous, but this is going to be different. I'm going to be doing like a series of me evolving as a stock investor, right? So, right now I'm at the knowledge part. I've been reading every single day, getting my knowledge up, and I have a few books that I've been looking at and reading. And stocks is definitely one of my passions. I think I know it's kind of like a boring passion, but I've been doing finance and stuff like that, and I really tend to enjoy the market. I think it's really fun. It's like a puzzle, and you try to figure out which company is going to be the next big company. And now I do want to mention that I'm going to be more in the valued orientated growth trading. Most likely intermediate term. I would like to be, I have a goal that I want to meet to an end. So, and I definitely have a strategy that I'm going to implement. Now, right now, guys, I haven't actually invested in any companies. I will be in the near future once I can. But at the moment, I'm just doing as much research as I possibly can, and I'm really, really starting to understand it, especially because I love finance, and I love the whole part of fundamental analysis and even technical analysis. I love to read about that stuff and learn it, and, I've been looking at financial statements, a bunch of them, just so I can kind of get a feel for how a financial statement should look. Now, of course, I'm more of a small cap trader. I'm going to be playing aggressive. I'm only in my 20s, so I want to take advantage of this. Now, I know it comes with a lot more risk, but I'm willing to take that risk to gain experience. Now, again, in stocks, right, you have to learn to diversify your portfolios to minimize risks. Valued risks, are you looking at the value of the price? Is the price earnings to ratio good? There's many ways of finding if the stock is valued, and that's what I'm trying to get good at, because I'm going to be more of a valued oriented growth trader. Now, I've never traded before. All I've done is research. All I've been doing for months, a few months or a month or so, is been basically just reading books on stocks. Now, I know I'm talking a lot, but again, this is going to be like a series where you guys can just lay back and watch, and we're going to get really good at stocks together. Now, what I'm going to do in today's episode is basically look over companies that I think is going to be a valued investment when in the near future, when I have that money to invest. At the moment, I don't. I wish I did, but this is where I'm trying to work every day to get some investment money to be able to start doing stocks. And once we start doing stocks, I'm going to be doing this series also where I show you guys what stocks I'm looking at and why and stuff like that. And I really hope you guys can learn from this also. And I've been just learning from books. I haven't been really watching videos because, no offense, I prefer to read a book that's more valuable to me. I know I'm going to read it, and actually it's about stocks, it's not going to be rubbish that I'm learning. So anyways, and again, I absolutely love finance. So the whole part of it is fun, the numbers to me. So guys, here's what I'm going to do. So like I said, here's our strategy, okay, for this series. Now, I want to make a decent amount of money when I'm in between 5 to 10 years, okay? That's my goal. Will I hit that goal? I don't know. Probably not, but I'm going to work every single day to get to that goal. And no matter what I have to do, I will do. So I have a strategy. So when you start in stocks, you need to have some sort of a strategy. Make sure your house is in financial orders, that you do have enough money to invest. You never want to put too much money in and then you have to pull it back out because you missed a bill on your rent or something like that. So, and that's what I'm doing. I'm making sure I have emergency funds and that I have enough money to throw away into stocks and invest that money. So first things first is, what I'm doing, since I can't invest, is I'm learning as much as I possibly can. I'm learning every single little thing I possibly can about stock investing. Now, I know quite a lot. I might not know the the best. Obviously don't know everything yet, but I will get better at it. So where I do most of my research, and again, guys, you got to understand that when I look for a stock, for example, I don't necessarily go at the stock market first. I check what's going on in the world, right? So, for example, like what industry is growing right now? What industry is making a lot of money? Is it the manufacturing industry, the auto sales industry, the cannabis industry? What industry? Technology. I'm looking at what industry is doing amazing and how is the economy doing in the world, because if the world's not doing good, most likely stocks aren't doing good either. So if I can find a stock in the right industry that I know will grow for years to come, for example, like the cannabis company, that is our cannabis industry. Cannabis industry is one of the things I will be looking at, because I'll be honest with you guys, I love cannabis. Who doesn't, right? It's like the new cigarettes. Like, obviously, people are going to invest in cannabis. It's the new thing. It's just because New York just legalized marijuana. Like, this is just starting, guys. And I think in the long run, cannabis will benefit you so much. And in value of stocks, because a lot of companies are just starting in this cannabis industry. And this industry is booming, guys. Like, it's earning so much revenue. It's ridiculous. Now, I'm not sure if it's like the top growing industry. I know it's one of the top growing industries. Definitely something I'm going to be looking at and that I like. Also, so like I said, I just pretty much look at how the economy is doing. What industry is doing, cannabis industry revenue. I look at the revenues that these industries are projecting or making. How much are they growing every single year? Like they might have made $800 million this year, which is like, that's good. That's 800 million. That's almost $1 billion. But, at the same time, you're thinking like, what if next year, like you don't know, like with cannabis you do though, because it's a new product. It's a new industry. It's not like technology or something that like the tech wreck that happened in the 2000s and stuff. Like that's been around for a long time. And I'm more looking at small cap stocks, small cap to mid cap, between 50 million to $1 billion, maybe even 10 billion max. But if the market capitalization is at 10 billion, I'm definitely still most likely going to invest, because mid cap companies, they still have that growth potential. They're definitely way less risky. There's still risk involved. Now, don't get me wrong. Every stock has risks involved, but when you're small cap trading, way more risk is involved, because you don't necessarily know how that company is doing yet. Like, unless it's well established and you see the fundamentals of the company and the bottom line is doing amazing, top line is doing amazing, check those things out. But, if you don't have a financial record for the past 3 years at least of how this company's been doing it, have they been losing money every year, just basic stuff. So now, like I said, I want to invest in things that I like, okay? Like companies that we like, cannabis I like, cars I love, technology I love. So these are all industries that I'm going to be looking at to throw money in. Now, why is that? Because listen, if the industry is growing, let's just say 20%, which is pretty high, but let's just say that, or whatever, let's just say they're growing substantially every single year in revenue, and this industry is making billions and millions of dollars. Those companies in those industries, no matter the financial strength, no matter what is going on with that company, it will still grow, right? Because it's in a growing industry, especially like one of the top growing industries. It might not do as good as other companies, but that's when you have to come in and compare companies, right? You never want to settle on just one company alone. That just doesn't make sense. You can if you find the winning stock, but if you don't, look around, compare stocks, see, is this stock really worth its value? Can I just find another stock that is pretty much the same as this company, that has better products, and it's cheaper in price, or they're more relevant, and they release their very niche products, they niche types of products, it's products that they're unique, so that's what I look for. I look for companies that might be the next Apple. And again, guys, I haven't invested yet, but I will be, in the long run. And I figured that maybe if I learn as much as I possibly can in the market, that when I come to invest, I'll know exactly what to do. And that's my goals. And I'm not saying that's going to happen, but I'm hoping that's what's going to happen. I'm reading every day and I'm trying really hard. I've been analyzing companies. And, when I look at a company now, I'm slowly starting to immediately realize what I should be looking for. And that's what I wanted. I wanted to just basically analyze companies, see what's going on in here. I do have a watch list set up in Yahoo. Now, in Yahoo, you can look at the most added to watch lists. You can watch like the top cryptos or anything you really want. You can worst performance, top performers, recently added, most followed. But I definitely look in the cannabis section, this cannabis watch list, because again, I really like cannabis, and this is what I'm looking at. I'm looking to see how are companies doing. Like this last price of AbbVie Inc., which I think is an American company, which it is. So, and this is a cannabis company. So what I do essentially is, now again, if you guys have any tips for me, please go ahead and let me know. This is why I'm doing this. If there's anybody out there that can give me more tips and stuff, and maybe I'm doing something wrong, I don't know. I've done my research. I've been reading books. I do finance. Like, I'm sure I'm not doing it that wrong. But if there's things that I'm doing wrong, please don't hesitate to let me know, because it's definitely something that I'm going to consider, and if there's any advice you guys want to give me, hey, Joe, maybe look at this, or hey, do this, or, definitely I'm going to take that into consideration. I'm going to take a look at these stocks or these tips you guys are giving me. So AbbVie Inc., right? So there's fundamental analysis and technical analysis, which I'm sure a lot of people know this already. Fundamental analysis, which is what I love, is the financials aspect of the company. Is it financially, how much financial strength does this company have? Is it weak? Is it strong? Do they have a good bottom line? Is their top line good? Are they growing in net profit margins and gross profit margin? Are they growing in net income margin? Like, you want to know, how are these companies growing? Because if you think of it, if you're an investor like I will be, and you're looking more for like valued growth stocks necessarily, now that's my plan. I want to be a valued oriented trader. Growth, small caps, maybe even more aggressive. So maybe play more intermediate, because I would like to make money within 5 to 10 years. If it takes longer than that, that's okay. It's just fun. But I think like 5 to 10 years would be my goal. So I would have to play more intermediate instead of long term, which is 10 years plus. I think intermediate for me. Now, I know a lot of people say intermediate is like weeks and stuff now, which is ridiculous. I'm more here for the long term. I'm not a day trader or stuff like that. I'm just looking to make growth within 5 to 10 years and have a good financial income. Not income trading, none of that, no dividends, nothing. I just want to find the next Apple, okay? That's what I'm doing. And it's a lot riskier than playing it safe, than investing in large cap companies, ultra cap companies that don't have that much growth, but are way, way less risky. Like pretty much the safest stocks you can buy. You pretty much won't lose money unless you play it wrong. But basically, what I'm doing is I'm playing at risk. Look, guys, I'm 20 years old. I'm going to be way more risk tolerant than most people are. I don't have kids. I have a few bills, and that's it. Okay, I live alone with my wife, and that's pretty much it, guys. Like, I'm able to take that risk. And it's something that I think if I implement that at an early age and I constantly practice that and I gain experience from that, let's say I'm 25. I already have 5 years of value-oriented growth trading, for example. So that's my goal, is I want to make sure that I can practice this every single day and read the news and get it down. And I don't care about making millions of dollars. I just do it because I love to do it. It's so fun. And it's like a puzzle, right? You're trying to figure out how's the economy doing? How's the industries are doing? COVID hit, okay? Companies dropped. So you got to figure all these things out. The PE ratio, depending on your strategy. If you're just kind of like a growth-oriented trader, you don't really care about the value of the stock. You would just buy it because you care about the future growth of the company and not necessarily buying it at an early where it's undervalued, right? And there is a term for that. I can't remember. I think it's overexhaust. I think it's called. I don't know. There's a term for when a company is undervalued. Well, undervalued is a term, but there's another term I read, but I'm not sure. I can't remember it. Anyways. you can see this company pays dividends. So right away, I'm an oriented growth trader. I don't want no dividends. I know some people might argue with me with that, but I'm not an income trader. I don't want an income through stocks. I want to put my money and I want it to grow. It's that simple. I'm not going to go buy stocks that are going to give me income. Like, I want growth. I want to put money somewhere. I want it to grow. And again, guys, there's a lot of risk involved, okay? And I'm willing to take that risk. I'm willing to learn from that risk. And that's where I think a lot of people can't do that, right? It's necessarily, I know I say this now, and I know when it comes to trading, it's going to be obviously more psychological about it. Like, it's going to be more mental because it's real money involved. When there's real money involved, you crap your pants sometimes. So when I have that money involved, I want to make sure that if we do end up losing money, it's just an experience. It's not something I'm going to get mad and over with. But let's just say you have $5,000, right? Let's just say you have $5,000. Well, you can diversify that $5,000 in investments, right? So let me give you an example. Like, let's say you have $5,000, and let's just say you want to put like $1,500 away, right? Well, into a stocks. Well, what I would do, for example, and this is what I'm going to do, is money management. Is maybe throw, because I don't want to throw too much money in. I don't have a lot of money. So I want to try to minimize the risk and grow, right? So if I can maybe put, $1,000 in this one stock, or even $500, and then I can look at another stock and put another 500 in that stock, and then I can find another one, and then maybe put 200 in that stock, right? You don't need to put your full 5,000 in two stocks because you're not really minimizing your risk. If you lose both of those stocks, you lost all your return. So it doesn't make sense. You want to make sure that you diversify your money, because even $500 over time will grow. And when that money grows, you can reinvest that money into the company, which gives you more shares, more growth. So that's my plan. Is I don't want to go over and just throw $1,000 into one company when I only have 3,000. I would rather put 500, 500, 500, 500, and then maybe 1,000 in a company that I think has a lot of potential. You always want to diversify, because I think it's really important. And I know some people might disagree with me on this, because I've seen some people where people say, oh, diversification isn't okay and you shouldn't diversify. Even Warren Buffett, I think, said that. But in all honesty, everybody's different. I think that diversification is really important, because what if one stock is a winning stock and then one other stock is another winning stock? Oh, but one stock is going down. Well, it doesn't really matter if that stock's going down, because you have 8 other stocks that are going up. Right? So you're not necessarily losing that money. You're you're diversifying your portfolio so most of your money can grow. And that's my perspective is, the more I can diversify, the more I could keep reinvesting in each company, the better the growth will be. Because if one company loses, it's not like I put half my money in there and then half my money's gone and I only have half my other money in another company that's barely making money. Right? It just doesn't make sense. So let's just go ahead and analyze a few companies here. I could talk this about hours, but let's just go ahead and we'll look at Canopy Growth for fun. Now, again, if I do some things wrong, just let me know. I definitely want to learn from that. I'm pretty good at this though, guys. Like, it's definitely not something that I'm horrible at, and it's definitely something that I've took a lot of time to learn. I might not have the experience like other people will, but I will, and you guys will witness that with me. It'll be super fun, and we'll be able to, I'll get new advice and stuff like that. So I'm really hyped about that. So first things first is I'll maybe look at the 52-week range, for example. Now, this in specific, I'm still learning. I'm still learning a lot of this as summary. I know that the price to earnings ratio, price to sales ratio, the dividend dates, target east, average volume of the stock, the volume that happened in that day. Currently, the stock is closed. It's at close. So the previous close of the stock was at $40.36. The open of the stock was at $41.37 today. So it boosted up a dollar basically in revenue. So in change, in cash, sorry. So basically, we can see off the bat, since a value-oriented growth trader, a valued-oriented growth trader, what I'm looking at immediately, first things first, is PE ratio. Okay, PE ratio. Now, the intrinsic value of the company is something you could always figure out later, and that's still something that I'm learning. Intrinsic value. I know the book value, which is the accounting book value of the basically what's the equity of that company? Is it close to the market capitalization of that company? So if the market cap is 15 billion, let's just say, which this is what I learned. So through my book is that the book value of the company, if the market capitalization, because market capitalization is the price times how many outstanding shares that company has. So this will keep changing. But if I see the market cap is 15 billion, let's go look at the financials, and I see this year their equity. If I look at their balance sheet, for example, now this is just one way of analyzing. We can see that this currently, the total stockholder equity is at 4 billion. Last year, they were at 6 billion. This year, increased $4 billion, 4.6 billion to be exact. If we go back to our summary, we can see that the market cap is 15.36, which in asset 15.36 with 4 billion, which is still quite expensive. The price of the share is more expensive than what the actual company is worth technically, right? Because its equity is only 4 billion, and that's what that company has increased in, and regarding of equity, and the market cap is only at 15 billion, right? So is at 15 billion. So that's like 3 times more what their actual equity is, what the company's actually worth, for example, right? Because then if we look at their equity, that shows you what that company is worth at that time. So we can see the company's worth 4 billion, 15 billion, market cap pretty high, right? You can see right now, just off the bat, there's not even a PE ratio. So what that means is if there's no PE ratio, basically, is there's no profits or earnings, basically. The company's most likely not making profits if there's no PE ratio. Now, we can see that in total revenue, this has gone up. Now, gross profit is what I most likely look at. Now, we can see the cost of revenue has also went up. Gross profit is what I mostly look at, which is total revenue minus cost of revenue, which will give you your gross profit. You can see Canopy in 2018 and then 2019, they grew by some 4% maybe. I don't know. To do the math, basically you just grab this minus this and then you divide that number you get and it'll get by this number and you'll get your equation. So gross profit is to see how much it has grown over time. You can just do 74,000 minus 88,000, which would give you a number. That number, you divide that by $74,000, this number, and it should give you a percentage of how much that company has grown over time. So it might have grown 4% and then it went down 3% or whatever, for example. So you can see in the last in 2020, they actually lost a gross profit of $31 million. So they lost money. So it's not like they actually increased. They actually lost a significant amount of profit, which is not what I like to see. Now, let's just see why. Okay, so if you look at the total operating expenses, this is what the company has to expense to earn this revenue. Now, you can see in 2020, they had a total operating expense of $993 million, and their gross profit was only minus 31 million. And even their total operating expenses didn't even cover their total amount of revenue, right? So basically, that doesn't really add up because there's more expenses than what they're making. You get what I mean? The total operating expense to run the company basically is they're earning, their expenses are more than what they're earning. So you can see they're in the minuses. They're operating in income loss, which in finance is not good. This is an income statement is to learn how much profit and loss you earned during that year, that month, quarterly, whatever. It's to see what's going on with your income. You know, is it going up every month? Is it going down every year? So basically, we could see their operating income from the business has been going down every single year. And it's not like it's in the minuses every single year. And it's not like it's been going down, 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 leading towards positive surplus number. It's actually going up. So there's something going wrong. They're not doing something right. Because what I can notice is their total operating expenses go up every single year quite significantly, except 2020, which it seems like it has gone down a little bit. But in the past 3 years, I look at past dates, and past 3 years, they've went up. So, yeah, total revenue went up also. But they're not even making enough to cover expenses alone, right? Because their expenses to run this company, to run the revenue, is even higher than what they're making. So they have to do something there. Maybe they're paying too much in selling. You can see right here. Yeah, they're spending a lot in research and development, but you can see they're spending a lot, and it's significantly increasing. This year, you can see to the trailing 12 months, you can see that they're currently at $618,000. So they have went down on that. Maybe they're cutting employees, staff. They're cutting maybe expenses towards staff and stuff like that, because selling general and admission can come from basically you paying marketing agents, things like that. So basically they've paid this much money in selling general and admissions, right? And research and development, they paid $62 million, $61, $15, and $1 million. Not bad. So they are increasing research and development, which is good. What I also look at is most likely net income. And I think net income, bottom line, is one of the most important things I'm going to be looking at. I could be wrong, but I think net income is super important, because net income is showing you if the company's even making profits or not. Is the company even earning an income? You can see right here they're not. They're not earning profits. They're losing profits. So how can a company run if they're not making profit over a significant amount of years? And it's not like their net income has went down from the minuses and then went from surplus. No, they've actually stayed in the negatives. They've stayed in the negatives, and they've actually increased in the negatives. So you can see there's definitely not some going. You can see income from continuing operations. And of course, there's a few things I'm still learning, like the income from continuing operations. Maybe this is something you guys can help me with. Basically, the whole point of this video is I'm just looking at a few companies, and we want to find companies together. I want to find companies where we think will grow, and I want to give you guys tips, from what I'm learning and from the experience I'm going to gain at 20 years old from doing this in the stock market. And I think it would just be fun if you guys could see a different perspective of a young trader, no bull crap, of you guys just seeing what I have to go through to do this stuff. So income from continuing operations, it's in the minuses, which not good, because interest expense, total other income / expenses net, which is total other incomes / expenses, any other expenses that might have accrued income before tax, which is in the minuses, income tax expense, so how much they paid in income taxes alone. So we noticed that the net income is basically, the bottom line is it's not good, doing good. It's actually increasing in the negatives, which is not something you want to see. Definitely not, because a company profits, it's like oxygen to people. Like, a company needs to have profits. How are you going to pay for your stuff if you don't have profits? An investor makes money if a company's making profits. So I want that company to save as much total revenue as they possibly can, cut down expenses, cut down selling and general admissions, cut down all these things that can serve you more profit in the long run. Now, you also have to understand that some companies, when they're starting, they might have to do a lot more expenses than they want. But that's because they may have a growth future potential. You have to spend to grow. That's just how it works. If you want to grow your company, you have to buy property, right? So expenses come with growing. But when they buy these properties, they will earn them revenue. If they buy something that's maybe for the company, they're opening another shop. Yeah, they have to spend money, but they know that in the long run, this shop will earn them revenue through the long run. So don't base your analysis off just, they're spending a lot of money on assets, for example, which is a good thing, or even in PPE, property investments, and they're not making that much money, but you see they're investing a lot of money. That could be good. Maybe keep your eye on the company. Don't necessarily just don't give it time. Remember, some stocks, you just have to give them time. Maybe if you're unsure on a company, just give it a bit of time. See what's going on with the company. Keep up with that company. See, how is this company moving? What products are they releasing? So you want to make sure that all the companies you're looking at, just because they're investing in long-term assets and stuff like this, and they're not even earning that much revenue. Again, that's management, right? You know, if management is doing things well and you're doing things well for your business, and they're managing that the profits we're earning. Okay, well, maybe we should only spend $2 million in property and investments this year because we've only earned a profit of 10 million and our expenses are 9 million or whatever. So, you know, the company also has to manage its money well. It has to be able to diversify its money to be able to earn more revenue down in the long run. So if you look at their actual total assets for Canopy, they have, so you can see it has grown a significant amount. A very, very big amount. In the first year of 2018, they had only 1 billion assets. Well, 1.4 billion. 1,436 million. That's how much assets they had. And then in the second year, and the year after that, they had 8 billion assets, which is good. Because you want that to increase because it shows you that the company is earning assets. They're growing assets, and assets can earn you income. So that's what you want. You want this company to keep buying assets, but they went down. So, you know, this would be a company that I would maybe just keep my eye on and just keep watching and see what they do with it. You can also asset return on equity. If you want to see how the management is doing, because you can't call them or anything, do a return on equity, which is basically total revenue divided by net income or equity. Sorry, if I remember that correctly. I could be wrong. But return on equity is total revenue divided by the return on equity, which I'm pretty sure that's what it is. It will give you a decimal number, and then you times that by 100, and that should give you your number, your percentage of how much is this company returning on their equity. Are they spending? Are they using their assets efficiently? Are they using their revenue efficiently to earn more profit? Now, you can see this company has goodwill, which is this is kind of something that I don't like. This is something that I just, it can be good. I just don't see the use of it in general. Because goodwill is goodwill, man. Like, if you're not earning net income in a surplus every single year, don't be doing goodwill. That's just my opinion. Intangible assets. Another type of assets. Tangible assets are basically, if I remember correctly, there's tangible. I think it's eligible and intangible assets, if I remember correctly. I don't know. I don't really remember. I learned that in finance, but intangible is pretty much assets that I'm pretty sure are like long you get like a patent for a product or licenses or insurance, or I think that's intangible assets. Intangible assets are like patents, you know, things of value that aren't necessarily assets, like a building or something like that. So liabilities, you could see that they've actually been doing quite good with the liabilities. It is increasing. It is increasing, but it's not significant. Like, it's not like crazy increasing. You know, it didn't go from 193 million to 5 billion to 7 billion, where it's basically the amount of assets they have. So you can see that they're kind of managing their liabilities in a certain degree. Now, 193 to 1 billion is high, especially 1.4 billion. You know, that's a big jump. That's a significant jump. But after that, you can notice that to trailing 12 months, there's only 1.7 billion. So it only increased by around 300 million. Right? So that's not that bad. So it's not that bad. Their liability, but their stockholder equity has gone up, which is also not that bad. But if we look in their cash flow, we can see that net cash provided by operating activities is, they're not even making money with this company, basically. So net cash operated by activities is not good. Depreciation and amortization. Depreciation, basically when an item depreciates its value over the years. Accounts receivable, you can see they only had it the first year, which is money owed to the actual company. Stock-based compensation, how much money the money made from stocks. Based compensation. Inventory, how much inventory they own or how much inventory they put money into. Cash flow statement is basically show you what the cash is doing in the company. What are they doing with their cash? That's basically all this sheet is. You can see free cash flow in the minuses, not the best. You can see operating cash flow in the minuses, definitely not the best. Net cash used for financing activities. So any sort of money that was raised from the company, which is through ads, whatever, I don't know, a raising fund, something like that. Finance activities that earn them revenue. And you can see their debts right here, debt repayments. They've only paid $6 million in debt so far, which is not that bad. Common stock issued. Is the company actually issuing more stocks to the public? Dividends paid, don't pay dividends, and stuff like that. So this company is definitely a company that I would maybe just keep my eye on. I'm not a big fan of the no profit being generated. That is definitely something that I just don't like. It just doesn't interest me. It's not. I know it's in a growing industry, so that's why I might give the company time. You know, sometimes a company just needs time to grow. So, guys, this was episode 1. I really hope you guys enjoyed it. You know, it's basically just me having fun, talking to you guys about stocks a bit, and, you know, trying to gain more knowledge in this, and definitely going to be, you know, I'm going to read every day about it. I'm going to try to get as good as I can at this. And, you know, I still have a lot of stuff to learn, a lot of stuff. And I know most of the common stuff now, and especially because I've been taking finance with my woman. So I've been learning a decent amount of finance, which I love, accounting. It's really, really fun. So, guys, if you guys enjoyed the video, please make sure to give it a like. If you guys want to see episode 2, I know this video is a bit different, and there was a lot of talking in this episode, so I do apologize for that. But, you know, this is just what I like to do, and if you guys are want to join the ride of our stock experience with us, please make sure to click that like button. And again, thank you guys so much for 172 subscribers. I will keep posting gaming videos, obviously, but this channel is going to be diversified. There's going to be so much uploads on everything. Stocks, gaming, whatever I want to. Eventually, even real estate when we're older. Something, I don't know. We'll see. So, anyways, thank you guys so much for joining. I really hope you guys enjoyed the episode. If you guys have any tips for me that I should be keeping an eye on or looking for, please just go ahead and leave it down below. I really do appreciate all of its support. I hope you guys have an amazing day. I hope you guys enjoyed the episode. I'll see you guys in the next one. Adios, guys.